Note that this conference is being recorded. I now hand the conference over to Mr. Sanjay Jain. Thank you, and over to you, Mr. Jain.
Thanks, Ranju. Good afternoon, everyone. Thank you for joining on the PCBL Chemical Limited Q4 FY26 results conference call. We have PCBL Chemical Management on the call, represented by Mr. Nilesh Kaul, Managing Director, Mr. Raj Gupta, Chief Financial Officer, Mr. Pankaj Kedia, ED, Investor Relations. I would like to invite Mr. Nilesh to initiate the call with his opening remarks, post which we will have a Q&A session. Over to you, sir.
Hi, good afternoon, everyone, and a warm welcome to you on the PCBL's Q4 and full year 26 earnings conference call. When we last connected at the Q3 earnings call, we had outlined the headwinds shaping our business. Softer global benchmark spreads, surplus domestic capacity, geopolitical uncertainty, and a sharp inventory adjustment by international customers. Most of these pressures persisted through the fourth quarter, and FY26 whole has truly tested our resilience and our business amid a challenging macroeconomic and industry environment. That said, while we faced significant headwinds last year, the broad industry dynamics have now started to show clear signs of recovery. Spreads appear to have found a floor. Exit quarter momentum has turned positive. The recent rationalization of US tariffs has restored a meaningful cost advantage for Indian exports. Customer pipelines in our specialty business are firming up, and the ratification of the India-EU FTA opens up a duty-free access to 1.8 million tons of carbon black market. We expect this recovery to consolidate progressively over the next 2 or 3 quarters. Today, I'll walk you through headwinds we navigated, the challenges that have emerged from the West Asia situation, the recovery signals we are seeing, the steps we are taking to strengthen our position, and the outlook for the year ahead. I will initiate by briefly talking you through the key financials and operational highlights of the quarter and full year. The most defining feature of the quarter was the escalation of the West Asia conflict, which began in February and created significant disruptions across our value chain and substantial increases in cost. With approximately 75% of our raw materials sourced from the US Gulf Coast and around 40% of our business driven by exports across geographies, we have significant dependence on global supply chain. And this quarter, we felt the impact on multiple fronts. The West Asia situation has created new challenges in terms of massive increases in logistics cost of feedstock, and the availability of ships and access to markets. While availability of CBFS itself has remained uninterrupted, as we continue to source from the US Gulf Coast, raw material prices have risen. Packing material costs have moved up materially, and freight costs have escalated sharply, exerting significant pressure on our margins during the period. Our key export routes to Europe and US pass through the conflict zone, causing disruption to the normal trade routes. Vessels are being rerouted via the Cape of Good Hope, adding at least 14 days to transit time and increasing logistics costs significantly. This rerouting has tightened container availability globally as vessels are caught in longer loops, and the effect is visible in ocean freight rates, which remain significantly elevated compared to pre-conflict levels. Through all of this, our priority has remained unchanged. The company is fully focused on ensuring timely supply to customers with no disruptions. I would also like to particularly acknowledge that most of our customers have been very considerate in sharing the increased cost with us, and I sincerely thank them for their partnership during this period. Our raw material is directly linked to crude price, and this quarter crude rose sharply and witnessed high volatility. Brent started at around $60 per barrel and ended March at around $100 per ton. As we speak, it's hovering close to $120 per barrel. A significant portion of our volumes flows through formula-based contracts with tire majors. Given that price contracts carry an inherent quarterly lag effect, the full impact of cost pass-through will reflect in our numbers by Q2 FY27, at which point our margins profile should normalize. In the spot market, cost pass-through has been initiated and will help offset the rise in input costs. We will continue to manage this actively as the situation evolves. A second important development is a clear shift in how customers are approaching their inventory. We are seeing a trend of stocking up at the customer level, which appears to be driven by uncertainty regarding the availability of materials going forward. Global tire majors are increasingly building strategic inventory buffers, transitioning from just-in-time to a more resilient just-in-case approach in order to mitigate supply chain disruptions. We expect this transition to translate into an incremental demand environment driven by restocking of carbon black across the region. Over the past few months, we have added 90,000 tons of carbon black capacity, enabling us to effectively cater to this increased demand. With the global carbon black market continuing to grow over the long term, we believe we are well placed to benefit from this structural shift. Domestic and export. In the domestic, sales have remained stable, supported by steady demand across key segments. Given our limited exposure to conflict-affected regions, except maybe a little bit for the specialty volumes, exports have remained resilient despite the uncertainty arising from West Asia situation. Around 40% of our total sales volume are exported, with South Asia being the primary markets and remaining unaffected by the ongoing conflict. To navigate the disruptions in West Asia trade routes, we have proactively rerouted shipments to alternate geographies, ensuring continuity and minimizing any impact on international sales. With supply chains stabilizing, we expect both domestic and export growth to continue in the coming quarters. We are deepening our presence through a service-led model in Europe and Japan, aiming to drive volume and market share growth through customized solutions with key players in these markets. Beyond the near-term disruption, the underlying fundamentals of our industry remain intact, and several structural tailwinds are turning in our favor. The India-EU FTA has been ratified, bringing duty-free access to an important market within sight. The recent US tariff reduction and duty refund benefits will also work in our favor. We are already in active conversations with customers in these markets and see good headroom for growth. Despite cost headwinds, the tire industry is navigating globally. Tire demand in the US and replacement segment has remained resilient. The Indian tire sector in FY27 is poised for robust high single-digit growth. High vehicle usage and aging commercial vehicle fleet support steady tire replacement demand in India. The industry is also benefiting from capacity expansion, premiumization, and electric vehicle EV adoption. On the special black outlook, in the special black segment, we took some price hike to meet the rising cost during the quarter. The near-term environment has been influenced by slower infrastructure activity. However, our products are gaining acceptance in applications such as industrial coating, supported by their performance characteristics. That said, we are seeing encouraging traction in segments like EV, semiconductor, data center, and AI-led investment. Overall, we remain constructive on the outlook and continue to selectively increase our focus on resource reallocation in this segment. Just a word on NanoWaste, which is our platform for battery in the coming weeks. On the R&D front, the team has been significantly strengthened with enhanced lab capabilities. Business development has also been expanded across key markets, including Europe and South Korea. Engagement with large battery manufacturers is already underway to validate product properties. Post-commissioning, a validation period of a few months is anticipated before capacity ramp-up begins. This represents a significant opportunity for PCBL to diversify into battery material industry, a high-growth, high-margin segment with strong long-term potential. A word on the initiative, cost reduction initiative I had talked about in the last quarter. This initiative has made significant progress in unlocking efficiencies across manufacturing and procurement. I'm pleased to share that the program is progressing well. Cost initiatives across yield improvement, throughput enhancement, and feedstock diversification are on track to unlock over 200 to 250 crores of savings over the next 4 to 6 quarters. We have also begun introducing agentic AI solutions on the shop floor. Early signs are very, very encouraging. Faster decision making is already visible, and we expect this to translate into improved uptime, better quality, and more consistent operations. This shift also calls for new ways of working and focused upskilling, which remains a priority for us. An added benefit is faster speed to market, from lab to actual commercialization, and the ability to introduce new solutions that support a more sustainable value chain. As part of our long-term cost resilience strategy, we are also actively pursuing feedstock diversification through backward integration into coal tar distillation. Increasing the share of coal tar-based feedstock for select applications is a key lever. Technical feasibility studies are currently underway, and we'll share more details in the next quarter. Now for the outlook. At PCBL, we are no strangers to adversity, and PCBL has navigated these challenging cycles in the past, be it raw material volatility, demand disruption, or global macroeconomic headwinds. And each time we have emerged stronger and more resilient. Through all of this, our priority remains unchanged. Ensure our customers face no disruption in supplies. We are doing everything necessary to meet their requirements without compromise. We have already taken steps to address the current environment by tightening procurement, accelerating cost optimization, and improving supply chain efficiency. As the environment normalizes and volumes recover, we are confident of delivering double-digit EBITDA growth fueled by volume momentum, leaner cost structure, and better pricing realization. We are maintaining capital discipline with investment priorities towards specialty carbon black, battery chemicals, and other value-added segments where margins are higher and growth is much faster. Importantly, we have used this period to strengthen the balance sheet. Net borrowings reduced by 454 crores to 4,536 crores during FY26, even while we funded 750 crores of capex. Our working capital cycle has tightened further. The platform we are entering FY27 with is materially stronger than we were 12 months ago. Just a quick update on the projects. With the 90,000 tons brownfield expansion of rubber carbon black at our Tamil Nadu during this quarter, our total installed capacity is now 880,000 tons per annum. The superconductive specialty black line of 1 KT at Palej is mechanically ready for commissioning. However, commissioning has been delayed due to gas shortage. The specialty black line of 20,000 tons in Mudra is now ready as well, and we'll be commissioning it in the next few weeks. Coming to the quarterly performance, during the quarter, our consolidated sales volume in carbon black business increased by 8% year-on-year to 161,865 metric tons. Consolidated revenue from operations during the quarter was 2,066 crores, and consolidated EBITDA was rupees 248 crores. Of the total carbon black sales volume, domestic sales volume grew by 21% year-on-year to 105,055 tons, while international sales volume decreased by 10% to 56,800 tons in Q4 FY26. Moving on to our segment performance, tires accounted for 88,591 tons, performance chemicals 53,888 tons, while specialty sales volumes goes up by 26% year-on-year to 19,386 tons. Power generation increased by 12% year-on-year from 175 MU to 196 million units, with external sales volume of 116 million units as against 100 million units in Q4 25. Coming to the full year performance, during FY26, consolidated revenues from operations stood at rupees 8189 crores as against 8404 crores in FY25. Sales volume for carbon black decreased 4% year-on-year to 618,956 metric tons in FY26 as against 596,262 metric tons in FY25. The consolidated EBITDA for FY26 stood at 1,081 crores as against 1,384 crores in FY25. Power generation was up around 14% and power sales volume by 17% during this financial year. Turning to our specialty and solutions business at Aquapharm, it continues to face challenging external environments. There are different dynamics shaping performance across our key markets. I'll take it one by one. Aquapharm reported sales volumes of 21,998 metric tons, revenue of 339 crores, and an EBITDA of 29 crores in Q4 FY26. For the full year, revenue was 1,443 crores and EBITDA Indian rupees 162 crores. Amidst the geopolitical conflict around the year, total sales volume in FY26 was resilient at 94,445 metric tons. During the year, home care sales volumes increased by 11% on year-to-year basis. Our water solutions business also faced headwinds, resulting in a 12% year-on-year decline. Application-specific solutions increased by 18%, while the oil and gas segment declined by 19% year-on-year, impacted by low oil rig counts and frac spreads in the US. Lower oil prices pre-war led to more cautious customer behavior and an indirect impact on realizations. In Q4 FY26, we faced multiple challenges during the West Asia conflict. Lead time and freight rates increased significantly, alongside a 25 to 30% raise in raw material prices. Yellow phosphorus, acrylic acid, malic acid, and other raw materials, packed materials cost also went up materially, up to 1.5 times. Disruption in LPG supply and increase in price during the war-impacted production, as LPG is used in a few of our processes. However, to ensure wallet share loss, we reduced deliveries in consultation with customers. And once again, I would like to thank our customers for their continued support and consideration during this period. In home care, we are locking in orders for FY26 with our key customers, and new products are also under approval. Similarly, for water solutions and green chelates, several products at the approval stage, and we expect these to materialize in the next few months. During the year, we have successfully expanded our capacity from 130,000 tons to 167,000 tons, enabling us to serve higher volumes going forward. We are expanding our oil and gas business by increasing wallet share and strengthening new customer engagement. We now have presence in Midland and North Dakota and have also received product approvals from new customers in LATAM. Overall, we remain positive on the strong growth opportunities in oil and gas. And based on historical trends, drilling activity should raise by around 30% at current crude levels. Overall, utilization levels should also increase with faster commercialization of new products and diversification of our product portfolio. With China implementing supply-side reforms, including VAT rebate cuts, provincial value-added mandates, and stricter capacity guidelines, we expect structural price improvement across various chemicals, and we expect to benefit from the same in the near future. To summarize, financial year 26 was a year that tested us, but it's also a year in which we deleveraged, advanced our growth pipeline, and built a sharper operating. The fundamentals of our industry remain strong. The early signs of recovery are clear, and we are entering financial year 27 with great confidence and purpose. With this, I'll conclude my remarks. Thank you for your attention, and I welcome your questions now.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Sanjay Jain with ICICI Securities Limited. Please go ahead.
Yeah, thank you. Thanks for taking my questions and for this opportunity. I got few across the businesses. First, on the carbon black, what is benefiting us because the profitability in the segment has gone up? It's purely because US tariff has changed where we were struggling, or there is a lower import coming from Russia thanks to the Middle East crisis. I can also sense inventory gain during the quarter, considering that there was a sharp increase in prices across commodity, which should have benefited. In this backdrop, how do you see FY27 panning out both from a volume perspective and the profitability perspective in the carbon black business? Thank you.
I think first there was some US tariff reduction has definitely improved prospects, which also means that more players are exporting material outside of India. And therefore, there's a little bit of reduced pressure on the prices in India. While the tire business is based on pass-through, in the non-tire business in India, we have been successful in increasing prices over the last few months. Of course, after the West Asia crisis, we were forced to increase even more prices, but structurally we have been able to improve some pricing in that area. That's one. Going forward, I think we are optimistic on both fronts in terms of volume improvement, both domestic as well as export, because the headroom for us to grow in export markets is significant. And we are implementing some supply chain initiatives which will unlock some markets which we could not access given the transit time, etc. On the pricing front also, while the industry continues to be overcapacity, we believe that structurally we will be able to take some price increases with value-added products coming into play, as well as introducing new services for the customers which unlock more value for the entire value chain and therefore sharing that with the customers.
Got it. But what is the reason for jump in profitability this quarter? If you can break that up, that will be really helpful.
Raj, you want to get into details, but essentially it's contribution increase, and yes, there is a lag in inventory valuation as well.
So this last quarter, if you're comparing with last quarter, it was not a usual quarter, right? And our profitability dipped significantly. So while quarter on quarter, when you're looking, it is appearing as a significant jump. But this is not where we should be with the kind of volumes that we have done. And of course, this quarter, the volumes have gone up by 1,000 tons. So volumes have contributed. EBITDA margins remain same. There's, not much improvement at EBITDA per ton level.
Per kg.
So the real impact of all the initiatives which Nilesh just spoke about is yet to come. It is still not reflecting in the performance.
No, that's clear. Second, Nilesh, on the entire shift towards coal tar distillation, we have been positioned ourselves as a crude-based feedstock producer. And coal tar pitch any which way is finding more buyer thanks to the multiple applications there. Now, what is driving us to reconsider a business proposition to shift towards coal tar distillation? That's number one. And number two, there's already established player who are procuring the coal tar. Now, how do we ensure that we get the feedstock?
I'll get into more details on this in the next call because the project feasibility is being finalized right now. But at the core of it is that we need to diversify our feedstock base. Second, it's not that we will use coal tar for all applications. This will be specific application based. So there are applications where coal tar based feedstock is slightly better. We have also upgraded our facilities to be able to use combination of feedstocks. So that will help. And as I said, I'll get more details for you in the next call where we would have already signed off the capex investment.
Got it. One last question on carbon black and then probably one question on Aquapharm. With the existing West Asia crisis, do you think we are in a better position from a carbon black manufacturing perspective and tapping the US market, or do you think Russia now has a chance of selling their product in Europe, or that's not happening?
We are seeing good traction from US customers, given that the tariff has gone down now. Of course, people are waiting for final stability in that structure. The logistics cost is a little bit challenging, but I think we are more competitive now than we were pre-war. So we stay optimistic for both EU as well as the US markets.
But how do you read the jump in the logistic cost? Because we are a bulky material, right?
Yes, but even with that, we are competitive in the U.S. market. As the U.S. customers are also, it's an underserved market, and the U.S. customers are also trying to diversify away because the competition is China, Russia, as you said. They want to diversify to other Indian players. Therefore, we believe we are still competitive in multiple applications.
Okay. Last one from my side on the aquafarm side. Phosphoric acid prices have gone up very sharply. That should itself have driven a lot faster growth in my view. Number two, crude prices very beneficiary for us in our US business. A combination of this, does it improve the outlook for aquafarm in FY27? Now, for last 2 quarters, we have been doing EBIT losses there.
So, Sanjay, yes, the phosphoric prices have gone up. We have also taken immediate price hikes from March onwards. So it will have some cushioning effect going forward. But as far as the oil and gas business is concerned, with this jump in the oil prices which we are seeing, we see substantial restocking impact coming in the first 2 quarters itself of FY27. So most probably you will see a decent growth on the oil and gas business in aquafarm in FY27.
And how should we see part to the profitability?
So as you see, from a profitability perspective, what has happened is a significantly lower capacity utilization in the last couple of quarters. That has led to some kind of negative operating leverage playing to our numbers. As we see Q1 and Q2 onwards, oil and gas business moving up sharply, the same thing will turn into positive to our advantage. So you will see profitability moving up as our overall capacity utilization moves up from Q1 FY27 onwards.
That's very clear. Just one balance sheet question. Sorry, I'm holding on more. Considering there is a sharp increase in the feedstock prices, that will put significant pressure on working capital and hence on the net debt position, which already appears to be stretched in correct profitability situation. How do we want to manage this entire leverage situation and still continue to grow?
Our overall borrowings have come down by about roughly 450 odd crores this year, as you must have seen from the balance sheet. You must have also noticed that our investment in working capital has also gone down significantly. So we are managing our receivables and inventory very tightly, and we feel that there is further scope for us to improve there. So we are instituting better controls. We believe that even despite crude being here, and we don't believe that crude is going to be here for the full year, we believe that, maybe in a quarter's time, we'll see crude should soften back to that 80, 90 level, whatever. Even if crude remains at $90 level, I think considering the volume growth, the revenue growth, we would require another 100 crore worth of incremental working capital. That's how we are estimating it as of now. And the cash generation with higher volumes and better margins will be far more than what we require to invest in our growth, pay out to shareholders, and invest in working capital for this incremental requirement.
Got it, Raj. Thanks, Nilesh. Thanks, Raj, for all those questions, and best of luck for the coming quarters.
Thank you.
Thank you.
Thank you. Next question comes from the line of Rohit Sinha with Sunidhi Securities. Please go ahead.
Yeah, thank you for taking my question, sir. So already some of my questions are answered. Just a few from my side. One is, as sir in opening remark indicated about this price increase pass on would be majorly reflecting from Q2 onwards, I guess. So just wanted to understand how this pricing pass on would be, playing out in the different segments for us, for carbon black as well as for the aquafarm also. And I think from March onwards, we have some higher prices which came down in mid-April. But again, this since crude has again started moving up, and probably there would be some adjustment in the contracts also. So how the contracts are shaped and how we should look at basically going forward our Q1 performance also.
So, as you said, different segments in our market have different pricing linkages. So in case of tires, for example, there is a structure where pricing can be linked to, and we have different types of contracts with tire consumers. Some are Q-1, some are M-1. So there are different pass-through mechanisms. So those will come into effect as and when the contract terms move along with it. There is also a significant piece of volume which is based on spot pricing. There we have anticipated and taken the prices up early. As I said, in March itself, we had started taking prices up, and price increases have gone through because obviously the entire industry is facing the same challenge. So we expect prices to be strong in Q1, and depending on how the crude situation moves, this will sustain. Some part of it we will lose later on as the crude prices hopefully come down, but we expect profitability improvement given the costing of our raw material available with us for Q1.
Okay.
Aquafarm is going to be a similar story for some segments where we have passed through and prices are linked to Q1, Q-1 or M-1 in some cases.
Got it. And sir, from our new battery business, how the things are progressing there, when we should be seeing the material numbers in that segment?
I think the pilot plant is ready. This, of course, is a very high value business with high margins, but it also requires qualification. So the pilot plant is designed to start getting qualifications done within this year. Then we will move on to putting up a commercial plant with additional capacities. I would expect that FY28 is when we will start seeing commercial volumes going up. We will share more details as we progress in getting more qualification with our customers.
Got it. And one last question for maybe for the guidance point of view, and how we should be looking at the volume growth in the carbon black side for next year, and for the power business also. I think I mean some outlook wanted to know as the demands are quite strong there, but pricing has not been to that extent. So are we seeing any material price increase also going forward in the power side, or it will remain more or less in this similar range?
I think on the carbon black business, now with our additional capacity coming in, we expect to see a high single-digit volume growth. We should see a much stronger, more than double-digit growth in EBITDA as well for the next year. As Raj was saying, Q4 results are not what we aspire to be, so you should see significant improvement in that going from Q1 onwards. On power side, the pricing, there is two components of it. One is the bilateral agreements that we have. Now there the pricing is moving well, and I would also expect that because of the fuel crisis in West Asia, we should start seeing some better pricing realization Q1 onwards as well. So we should see structurally better pricing in power business as well.
Okay, that's it from my side, sir. Thank you. Thank you very much.
Thank you. Next question comes from the line of Aditya Khetan with Smith's Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity. Just a couple of questions. Sir, you mentioned in your opening remarks on the carbon black spreads bottoming out. So what are the indicators, like, if you can highlight, and what is giving you that confidence that this has bottomed out? And what are the triggers wherein it can improve, apart from what we say that tire demand will grow? Any structural change in the business we can see, okay, now this has bottomed out? And so comparing with last quarter, actually spreads look much lower here, adjusting for the inventory gains. So what has changed, and what is giving you that confidence that it has bottomed out?
See, for the Indian players, some of the positive things that we are seeing is because the US tariff issue is to some extent sorted out. So the additional volume coming into the Indian market is now moving towards US as well. So you should see some improvement in volumes being exported out of India, which therefore reduces the pressure on pricing in India. That's number one. I think we are also continuing to see some inventory build up by our customers as well, which is a little bit of an additional demand coming through, and again should allow us to start charging a little bit more premium. Third, of course, is the value-added component of our business is going up, and we expect to see that also helping us improve our spreads.
Got it. Sir, onto the customer side, like you mentioned, so customers are keeping some inventory, which earlier they were taking just in time. So can you highlight like what are the inventory levels today with the tire players of carbon black and specialty and aquaform across businesses?
It varies by customer to customer. So depending on the market that you're talking about, for example, our domestic customers usually were keeping about 3 to 7 days, depending on the location of their plants, etc., which they are dialing up a little bit given the uncertainty. In export markets, again, it varies across the value chain. What we are looking at doing is actually providing some more additional inventory stock points for just-in-time delivery as well for the longer term. This is not going to come in effect right now. It will take a little bit of time to do that. But customers are increasing their cover for beyond increasing that by at least 3 to 4 days minimum, as we see as of now. And this is true for specialty as well as for tire customers.
Got it, sir. Sir, onto the aquaform, like you mentioned, so with the rise in crude prices, definitely coming quarters should look good. But you also mentioned onto the restocking pickup. So suppose, sir, if tomorrow all these things stabilizes, the West Asia crisis, everyone is anticipating crude price to fall down. So still this thesis will remain intact that demand will pick up and restocking thing also will continue, or we could be back to that original levels like we were saying earlier.
So this we are not banking only on the inventory increase. We are also making efforts to grow share of wallet in terms of providing value-added services and solutions for customers. As I mentioned, there is a lot of new product approvals that we have got. So we are seeing positive traction beyond the immediate impact of inventory increase. So structurally, we believe there is enough growth in the key segments, oil and gas, in water treatment and the home care segments, especially as we have got now greener products coming into the mix, and we should see increased volume. So no, structurally, we are making efforts to ensure that profitability goes up.
So current quarter, when we look, so we are sitting at around 29 crores sort of an EBITDA, which I mentioned in the presentation. So the next year, considering if things normalizes and you're mentioning that premium mix will go up, can we again go back to that levels of 50-55 crore EBITDA per quarter in aquaform?
Yes, Aditya, we believe we should be able to do that.
Got it. And sir, onto the volume side, any number for FY27-28? Like earlier, we had said for 26, so double-digit volume growth, but I think we are at flat. For FY27-28, any number guidance?
Specifically for aquafarm?
Yes, aquafarm.
Aquafarm should see a very strong growth in top line in FY27. I think in the region of 20-25% is something which we believe should be able to achieve.
Got it. So just one last question onto the debt part. You had mentioned that we have also reduced some of the debt. Along with that, we are also into capital expenditure mode. So this will continue in FY27 also, both paying off debt and simultaneously doing capex 27-28. How you see like things shaping up on this front?
Yeah, we feel that we can generate more cash from operations than what we require to invest in growth, and therefore there should be net reduction in overall leverage.
There was one last question that we mentioned in our investor day earlier, some 40 billion guidance of EBITDA by 2030. So does that hold, or is there any change onto that?
So the long-term fundamentals of the industry remain intact. These are short-term, some headwinds that we are facing currently. So from 2030 perspective, we are very confident. We remain on track, and with all the initiatives that we are taking, we believe that we should be able to deliver those numbers.
Got it, sir. Thank you. That's it from my side.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Next question comes from the line of Preet Nagatret, Wealth Advisor. Please go ahead.
Yes, thank you. My question is back to the EBITDA per ton for FY27. So if I understand, you said you are expecting a double-digit growth on the EBITDA. So should I assume that the 14,900 odd per ton, we should see at least about a 14-15% increase on this number? Is that what this leads to?
We should easily see that, yes.
Right. And
because it's a mix of just to clarify, it's a mix of both. We expect pricing to move up, and we also are taking significant initiatives on cost. So combination of that should definitely deliver that.
And here you are coming to this number based on two factors. One being the volume growth of high single digits, so 7, 8, 10%, 9%, and the value growth of the remainder to get to this number. Is again the understanding correct?
So let me recap this. So there's three elements. One is, of course, the volume growth. Second is a product mix change. We are getting higher value-added products coming through. The third one is general price increase. And sorry, there's a fourth one, which is the cost initiatives, which we are also taking.
Understood. So basically, effectively, the EBITDA ton moves up by a strong double-digit number, and we should also see maybe revenue increase, volume increase alongside all of these things.
Yes.
Right. Wonderful. Okay, great. Thank you. The other questions have been answered.
Thank you.
Thank you. Next question comes from the line of Sailesh Raja with B&K Securities. Please go ahead.
Yeah, sir. In the last call, we had mentioned that Aquapharm received incremental allocation from customers like P&G, Henkel. So could you quantify the potential volume growth expected from these two allocations over the next 1-2 years? Also, regarding the recent, the removal of 13% VAT, the export rebate, which you were talking with benefit in China. So specific to TBTG products, so within the Aquapharm, the overall volume mix, what proportion of volume is currently derived from TBTG product? And what about the operating profit growth that we are expecting in Aquapharm?
So Sailesh, specifically if you talk about the green fillets portfolio, where we last quarter also mentioned that we have started receiving trial orders and supplies have started to both P&G and Henkel. There, I think from Q2 and Q3 onwards, we see significant increase in the expected sales revenue as we get product approvals and supply moving up. So from potential perspective, potential is large. We ourselves have limited capacity. Our overall green fillet capacity is 4,000 tons, and we have been looking at expanding that capacity. But we have been waiting for product approvals to come in so that we don't set up capacities too early. Now, as we see increasing sales in the green fillets portfolio, both FY27 and 28, you should see significant increase in the revenue side, and we will be adding more capacities on the green portfolio for Aquapharm. Your second question was on the...
Yeah.
Please tell me.
Continue. No, so please continue. Yeah.
So once we get these product approvals from P&G and Henkel, we are also working with more customers to get product approvals from the non-detergent side of the business too. So this should help us to have a larger revenue increase from this green fillets portfolio.
Okay. So can you please quantify that? We are expecting around 20,000 tons incremental number.
Sailesh, your voice is not audible.
Hello? Yeah. Sir, we are expecting 20,000 tons incremental number. Can you please quantify, sir, the volume that you are expecting from these two customers, and also the EBITDA growth that you are expecting from Aquapharm?
A couple of things. The requirement of these customers is pretty large. I mean, we will not be able to supply that requirement with what capacities we have. So if I tell you about the opportunity size, it is pretty big. Once we have received the trial orders in the last quarter and the supplies have started now, we have to build up that portfolio gradually. So if you recall, a couple of years back also, we had mentioned that we have a very large ambition on the greenfield portfolio. We have some capacity. We are now getting trial orders, and more orders are expected to come in a couple of quarters. So by the end of this year, we should have a much larger say when we talk about the greenfield portfolio. The challenge is not the target market or the size of the market. And from an EBITDA perspective, I think while last quarter has been a challenging quarter in Aquapharm, and we faced multiple challenges, which Nilesh also mentioned during his opening comment, we believe that our goal remains to reach that 75 crore per quarter EBITDA run rate, which we have been trying to achieve in the last few quarters. And if the market would have been in a normalized scenario, we would have achieved it by now. But over the next 2 or 3 quarters, we believe that that goal remains intact for us to reach 75 crore run rate on a quarterly basis.
Okay, sir. Yeah, great, sir. Sir, the Europe market, if you see the carbon black, the size is around 1.5 million tons. Just to understand better, to see this potential benefit from EU FTA, that could you please help us with the current supply mix? How much of demand is met through domestic production versus imports? And within imports, what is the share from China, India? Is there still some Russia supply is coming to Europe market? Could you please talk about that?
Shailesh, hi. Europe, on an average, imports about 500,000 tons of carbon black every year. And earlier, almost 80% of it used to come from Russia. Now, of course, it is spread across a number of countries. India currently is doing about close to 100,000 tons to our understanding. And China share would be a little more compared to us. Rest is coming from multiple geographies. Now, in terms of how this EU FTA is going to benefit us, there is no import duty on carbon black in Europe. So there is no direct benefit, but when you look at indirect benefit, currently tire imports in EU from India that attract 4.5% duty. So once this FTA is signed, then that duty is likely to get to 0%. And Europe is Europe accounts for 1/3 of India's tire exports. So, that should boost up domestic production in India. And from that perspective, it is going to be positive.
So how much is domestic carbon black imports, sir?
In Europe?
No, India, sir. India import.
In India, it's not significant.
From where?
From China and Russia into India.
China and Russia is not much. China does roughly about 1,500 tons a month. And Russia would be around similar, around 2,000 tons a month. India in totality imports about 8,000 to 10,000 tons a month.
Okay, sir. Yes, sir. Thank you, sir. Thanks.
Thank you. Next question comes from the line of Shashank Kanodia with ICICI Securities. Please go ahead.
Yeah, good afternoon, team. Thank you for the opportunity. So, sir, given the current crude prices, what kind of blended carbon black realizations should we look for Q1 FY27, given that you clock closer to 105 rupees per kg in Q4?
Sorry, I couldn't
get the question. If you can say that again, please.
Yeah, so what kind of blended carbon black realizations should we expect in Q1 FY27, given the crude prices that they are currently hovering at?
Around $1,400 to $1,500.
Okay. And that is true for Indian markets as well, right, sir?
Yeah, I'm talking about average, blended, both domestic and international.
Right. And sir, at the current level of crude prices, how is the CBO versus CBFS profitability? So do we see more of Chinese supply getting into the market at the current crude prices, which is coal tar based, or CBFS as a route is still has an advantage position?
So the coal tar prices have also moved up. So it is even keel as of now. So pre-war and versus now, it's about the same levels of difference. So when it is imported coal tar into India, it's still a little bit more expensive on a TCO basis because there is a difference in yield which we get between CBFS and coal tar. So competitive, but CBFS is better for us right now.
Okay. And sir, for a quarterly breakup of volumes that you have shown in the presentation, your tire space volumes have declined from 90,000 odd tons in Q4 to 88,500 tons KT for this quarter, whereas the domestic tire space has grown highly double digit. So is it just purely out of profitability angle that we have supplied less to the industry, or is there some market share loss, some angle to it? I'm talking about quarterly sales volume for tires, performance, specialty that we have showcased in your presentation.
Performance specialty, 1 second.
I'm talking about tire, particular getting potentially declining sales volume. 90,000 KT last quarter, and then Q4 to 88.6 this quarter.
This is just a customer mix that we had. And it's just a timing effect in terms of when the material got supplied. So overall, we are going to see growth in tire business as well.
Right. And lastly, sir, do we see
Q1 you should see higher volume from us on tires.
Okay, sir. Sir, given that there are state elections in a home state, is there any recurring one-time expense charged to a P&L for this quarter, or do we expect something in Q1?
Sorry, again,
you have to repeat.
So I'm saying that, sir, given that there are state elections in your home state, do we see any one-time recurring charge which is non-recurring in nature, either in Q4 or in Q1? So we had a history of, some donations in the past. So do we see that as an element for Q4 or next quarter, Q1?
Nothing significant, Shashank.
Okay. And sir, given that you're expecting good amount of profitability increase for base carbon black as well as aquafarm, in FY27, do we surpass the FY25 base case profitability in terms of EBITDA impact?
Yes.
Sure, sir. Thank you so much and wish you all the best. Thank you, sir. Thank you.
Thank you. Thank you.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.